Gold just did something it's never done before. And if you have any money in the bank, any investments, or any concern about what's happening to the dollar, you need to pay attention to what happened on October 7th, 2025. Beyond the noise, find your clarity. This is smart money sense. For the first time in human history, gold futures crossed $4,014 per ounce. Spot gold hit $3,977. This isn't just another record. This is a 51% surge in a single year, the best performance since 1979. But here's what really matters. This move is telling us something critical about the global financial system, about the dollar, and about where smart money is positioning itself right now. Before I break down the 5 forces behind this historic move, hit that subscribe button. This channel exists to cut through the noise and give you financial clarity you can actually use. And if you're getting value from this breakdown, smash that like button. It helps more people find this analysis when they need it most. Why this moment actually matters. You might be thinking, so what? Gold hit a new number. Why should I care? Here's why. Gold doesn't move like this because traders are bored. When the most ancient store of value in human history rockets up 51% in 10 months, it's a signal. It's telling you that something fundamental is shifting in the global financial architecture. Billionaire Ken Griffin, who runs $170 billion at Citadel, said on Monday that the rush to gold as a safer asset than the dollar is concerning. Let that sink in. When one of the smartest money managers alive is concerned about gold replacing dollar confidence, you should be paying attention. This isn't just a gold story. This is a dollar story. This is a Federal Reserve story. This is a what happens to my savings story. And by the end of this video, you'll understand exactly what's happening, what it means for your money, and what moves you might consider. Force number 1, Federal Reserve rate cuts. The Federal Reserve is cutting interest rates, and the market knows more cuts are coming. Right now, traders are pricing in a 92 to 95% probability of a 25 basis point cut at the Fed meeting on October 28th and 29th. Another cut is expected in December. Goldman Sachs forecasts the Fed will cut rates by 100 basis points, that's 1 full percentage point, by mid-2026. Why does this matter for gold? Gold pays no yield. It just sits there. When interest rates are high, holding gold means you're giving up the interest you could earn in bonds or savings accounts. But when rates drop, that opportunity cost shrinks. Suddenly, gold becomes more attractive. Lower rates also tend to weaken the dollar, which brings us to force number 2. But before we get there, quick engagement check. If you're finding this breakdown useful, drop a comment below with your biggest takeaway so far. And don't click away, because what I'm about to share about the dollar might surprise you. Force number 2, the crumbling dollar. The US dollar index has dropped 10% since the start of 2025. 10%. That's the worst 6-month performance in over 50 years. The dollar is sitting at 97.4 to 98.5, levels we haven't seen in years. Why is this happening? It's not just about interest rates, it's about confidence. It's about fiscal deficits that keep growing. It's about trade tensions. It's about sanctions that made countries around the world realize that holding too many dollars might be a risk. When the dollar weakens, gold priced in dollars becomes cheaper for foreign buyers. Demand increases, prices rise. But there's something deeper here. For decades, the dollar has been the world's ultimate safe asset. But that trust is eroding, and when people lose faith in the dollar, they don't rush into euros or yen, they rush into gold. Force number 3, central banks are buying like never before. This is one of the most important and underreported parts of this story. Central banks around the world are hoarding gold. In the second quarter of 2025 alone, central banks bought 166 tons of gold. That's after buying over 1,000 tons per year for 3 straight years, from 2022 to 2024. China is leading the charge. The People's Bank of China just extended its gold buying streak to 11 consecutive months, from November 2024 through September 2025. They added 39.2 tons during that period. China now holds 2,303 tons of gold, worth between $283 and $369 billion. That's 7.64 to 7.7% of their total foreign reserves. But it's not just China. Poland was the biggest buyer this year, adding 67 tons. Countries around the world are diversifying away from the dollar. And here's the kicker. Analysts at Goldman Sachs say central banks will keep buying an average of 80 tons in 2025 and 70 tons in 2026. This buying alone is expected to add 19 percentage points to gold's price appreciation. One strategist put it this way: foreign central banks now officially hold more gold than U.S. Treasury bonds for the first time since 1996. That's not just a statistic, that's a tectonic shift in global finance. If you're still watching, you're in the top 15% of viewers who actually stick around for the full analysis. That tells me you're serious about understanding money. So do me a favor. Subscribe if you haven't already, and hit that notification bell so you never miss an upload. There's more critical information coming, and you don't want to miss it. Force number 4, investors are flooding into gold ETFs. Institutional and retail investors are piling into gold at a pace we've never seen. September 2025 marked the biggest monthly inflow into gold ETFs on record. The third quarter overall saw $26 billion flood into gold-backed exchange-traded funds, the strongest quarter ever recorded. North American investors led the way with $16.1 billion in inflows. European funds had their second-best quarter ever with $8.2 billion. Total assets under management in gold ETFs worldwide hit a record $472 billion. Up 23% in just one quarter. Gold holdings in ETFs reached 3,838 tons, just 2% below the all-time high of 3,929 tons set back in November 2020. Being asked, why are investors doing this? Fear, uncertainty, inflation concerns, distrust in government finances. Whatever the reason, money is moving, and it's moving into gold. Force number 5, geopolitical and economic uncertainty. The U.S. government shutdown entered its second week on October 7th, leaving traders and policymakers without critical federal data, including the monthly jobs report. Inflation data for September was delayed. When people don't have data, they get nervous. When they get nervous, they buy gold. Add to that ongoing trade tensions, tariff threats from President Trump against trading partners, and sanctions that froze $300 billion of Russian reserves after the invasion of Ukraine back in 2022. The world is watching and thinking, if it happened to Russia, could it happen to us? Better to hold gold. This is the perfect time to ask yourself, are you prepared for more uncertainty? Are you diversified? And speaking of preparation, there's a major warning sign flashing right now that you need to know about. Warning, is gold overbought? Not everyone is bullish. Bank of America analysts are warning that gold may be overbought. Here's their case. Gold has risen for 7 consecutive weeks. Since 1970, this has happened 18 times. Historically, after such a streak, gold only posted additional gains in the following 5 weeks 28% of the time. Gold is now trading 20% above its 200-day simple moving average. Historically, gold tends to peak when it's 25% above that average. We're getting close. The 14-month Relative Strength Index, or RSI, shows gold is heavily overbought. When the RSI crosses above 70, it typically signals an asset is overextended. Gold has been there for over a month. Technical strategist Adam Turnquist from LPL Financial recommends adding exposure on weakness given the degree of overbought conditions. In other words, don't chase it here. Wait for a pullback. Key support levels are at $3,850 to $3,900. If gold dips to that range, that might be a better entry point. But if momentum continues, analysts say gold could hit $4,100 to $4,300 in the short term. If you've made it this far, you're clearly committed to understanding the story. Let me know in the comments. Do you think gold is overbought, or is this just the beginning of a bigger move? I read every comment, and I want to hear your perspective. What the smartest investors are saying. Ken Griffin, CEO of Citadel and one of the most successful hedge fund managers in history, dropped a bombshell on Monday. He said, "We are witnessing significant asset inflation away from the dollar as individuals seek effective methods to de-dollarize or mitigate their exposure to U.S. sovereign risk." Translation: people are losing faith in the dollar and they're moving to gold. Griffin went on to say that investors want to participate in U.S. stock market gains, but are hedging those gains against U.S. sovereign risk. That's a massive shift. It means even people bullish on America are worried about the currency and the debt. Meanwhile, Goldman Sachs just raised its gold price target for December 2026 from $4,300 to $4,900. That's a potential 23% gain from current levels. They're basing this on continued central bank buying, Fed rate cuts that will lower real yields, and sustained investment demand. Michelford, an investment officer at Scorpion, predicts gold will hit $4,300 within the next 6 months as the dollar continues to depreciate. So, should you buy gold at $4,000? This is the question everyone's asking. And here's the honest answer. It depends. It depends on your financial situation, your risk tolerance, your time horizon, and your existing portfolio. But here are some principles to consider. Gold is a hedge, not a growth investment. You buy gold to preserve wealth, not to get rich quick. If you believe inflation is coming, if you're worried about the dollar, if you think central banks will keep printing money, then having some gold exposure makes sense. Most financial advisors suggest allocating 5 to 10% of your portfolio to precious metals. You can do this through physical gold ETFs like GLD or IAU, gold mining stocks, or even digital gold platforms. Each has pros and cons. Physical gold is tangible but comes with storage and insurance costs. ETFs are liquid and easy to trade but don't give you actual metal. Mining stocks give you leverage to gold prices but come with company-specific risks. One thing's for sure, don't put all your eggs in one basket. Diversification is key. And never invest based on fear or hype. Make decisions based on data, strategy, and a clear understanding of your financial goals. You've just gotten one step smarter. To keep building your financial sense, check out the playlist I've linked in the description and subscribe so you never miss an insight. This is Smart Money Sense. If this video helped you understand what's really happening with gold, hit that like button. Share this with someone who needs to hear it, and drop a comment with your biggest question about gold, the dollar, or investing. I respond to comments and I'll do my best to answer. Gold hitting $4,000 isn't just a headline, it's a signal that the financial world is changing. The question is, are you prepared? Are you paying attention? Because the noise is loud, but the signal is clear. Smart money is moving. Make sure you know where and why. See you in the next one. Keep building your sense.